Okay, so we were talking about government issuing bill. Hmm? And so let's go line by line again. Although the terms are used loosely, bonds are generally long term. Yeah, we told that it's about 10 year only, where notes are intermediary terms. So the 3 to 5 years intermediary terms are notes. Commercial paper refers to short term, means 1 to 2 year. Okay, so we have a look into that part. Now let's go into another line. Government issues bills and bank issues certificate of deposit. So who issues bill? Government issues bill and banks issue certificate of deposit. Okay, in repurchase agreement the borrower sells a high quality asset. So CD is being issued by banks and bills are being issued by government. In repurchase agreement, the borrower sells a high quality asset and has both the right and obligation to repurchase in the future. So the borrower is selling a high quality asset and they both have the right to obligation to repurchase at a higher price. That is the repo rate what is happening. So if I want an immediate cash, I just borrow and I just promise that I will repurchase it at a future later date. Okay, so that is repurchase agreement. So it's obviously in the higher price only because one who is lending, they need some benefit, right? Repurchase agreement can be for short as 1 day. As I told that libor software all works like in overnight repo rate are basically repurchase agreements only. So this is also covered. Now moving to next, convertible debt is that an investor can exchange for a specified number of equity shares of the issuing firm. Convertible debt means if you're buying a debt or a loan, it can be converted into equity. So these are convertible debt. So this can be exchanged for number of equity shares of the issuing firm. Okay, so convertible debt, I hope it is clear. Convertible debt, I am just noting down just to revise at the end. Very simple. Now let's coming after we have seen about the debt, let's see about the equity securities. Equity securities represent ownership in a firm. Like there are let's say 10 like one chocolate and it has 4 parts. Okay, now one part, if I am buying like the chocolate it of 20 rupees, it have 4 parts, so 5 rupees each. So if I buy a 5 rupees part 1/4 of a chocolate, I am still owner of the for dairy milk. This is how the stock market actually works. They are giving about they are giving the ownership stake to the public. Okay, so this is why ownership in a firm is written, and it's include what all is include: common stock, preferred stock, warrants. Now what are they? Now let's go into the more basics, have a glimpse of what are they. So when we are now talking about equity securities. Okay, we are talking about equity securities. So here first we are learning that it consists of common stock. It's basically is ownership but includes, okay, it's include common stock, preferred stock, next is warrants. Okay, now let's deep dive into it. So what do you mean by common stock in general? It is a residual claim on the firm's asset. Okay, so it is a residual claim on the firm's asset. Common stock dividends are paid only after interest is paid to debt holders and dividends are paid to preferred stock holders. So they are basically telling that preferential shareholders are basically the first the right, then the equity shareholders have the right. Furthermore, in the event of firm liquidation, debt holders and preferred stockholders have priority over common stockholders and usually paid in full before common stock holders receive any payment. So in this common stock point, nothing is there. The point just emphasis on preferred shareholders are paid first, then only common shareholders are paid anything. Now next is what is preferred stock? It's an equity security with scheduled dividend that typically do not change over the security's life and must be paid before any dividends on common stock must be paid. Okay, so there is preferred stock and one is common stock. In preferred stock, the dividend is very much fixed, and your any claims like dividends and all stock, preferred stock is paid, preferred stock shareholders are paid first, then compared to common stock. So there was nothing much there. What is preferred stock definition? Nothing is there. They are just emphasizing on preferential shareholders have the preferential right over the common stock equity shareholders. Now what are warrants? It is similar to option in that they give the holder the right to buy a firm's equity shares at a fixed exercise price prior to the warrant expiration. So warrant is somewhat, you have to learn the concept here. If I am giving you 100 stock warrant, okay, that you are a new employee in my company, and I am telling you that I am giving you a 5-year warrant. Okay, it is like 100 stock I issue as warrant to one person only. It's like 5 year, and I tell you that you anytime you can exercise the Reliance share at 200 rupees, which is now about 2000 rupees. So it is known as warrant. You have the option to exercise the right before the expiration at a fixed exercise price, and I will fix when I issue the warrant. Okay, now next is fixed investment vehicle. Okay,
നമ്മുടെ പ്രിയങ്കരിയായ സാരഥി സെബീന ഹാരിസിന് കന്നഡ ചിഹ്നത്തിൽ നിങ്ങളുടെ മനസ്സാക്ഷിയുടെ അംഗീകാരം രേഖപ്പെടുത്തണമേ എന്ന്
we have validity instructions, and I have went far a bit.
നമ്മുടെ ചിഹ്നം സെബീന ഹാരിസാണ് നമ്മുടെ സാരഥി.
Okay, so we were actually have not reached yet here. So we were actually on where were we actually? Okay, we are on warrant. Now let's come to pooled investment vehicle. So what is pooled investment vehicle? It includes mutual fund, depository and hedge funds. The term refers to structures that combines the fund of many investors in a portfolio of investment. The investor ownership interests are referred to as shares, units, depository receipts or limited partnership interest. So basically most of us are knowing about mutual fund. Everyone is paying about 100 rupees, 200 rupees to the mutual fund house. So what the mutual fund house is doing, actually it's collecting as a pool, and it's collectively it is managing the fund. So we are sharing, we can see that as NAV or share as unit or deposit receipts or limited to partnership interest. Not only to mutual fund but depository and hedge fund all work in as pooled investment vehicle. So now let's come into the type of this. We have mutual fund. It's very simple. It's a pooled investment vehicle in which investors can purchase shares either from the fund itself, open fund, and or in the secondary market, closed-end funds. And the second is exchange traded fund. Exchange traded fund or ETF and ETN. It may be something new to you. What is ETF and ETN? ETF and ETN trade like closed-end funds but have special provision allowing conversion into individual portfolio security. Okay, so these are basically closed-end funds. So basically let's write it down. I hope that you are taking notes. So we were learning about pooled investment vehicle. Okay, so first there need no explanation, but now we are learning about ETF and ETN. So what are they? It is basically a closed. It is open end fund or closed end fund. It is closed end funds, but have special provisions allowing conversion into individual portfolio security or exchange of portfolio share for ETF share that keep their market prices close to their proportional interest in their overall portfolio. These funds are sometimes referred to as depositories, which their share referred to as depository receipts. Okay, so what it is telling, it is has special provisions allowing conversion into individual portfolio security. So if I am holding an ETF, I can convert. So ETF will be having so many shares inside it. It's a pooled investment vehicle, so I have the authority to convert it into like individual shares. Okay, so I'm having that authority, like I can convert into individual shares that keep their market price close to their proportional interest in their overall portfolio. These funds are sometimes refers to as depositories. Okay, which their share refers to as depository receipts. Okay, so ETF funds and ETN funds are basically in the indirect way sometimes refers to as depositories, where the shares refers to as depository receipts. Okay, so in the last few slides we have seen that asset backed securities. I told that we will not go into depth, but here we are seeing again the topic in emphasizing this point only. So it represents a claim to a portion of a pool of financial assets such as mortgages, car loans, credit card debt and all. So it's a pool of financial assets, such as mortgage, car loans, credit card debt, etc. The return from the asset is passed through to investors with a different class of claims. Maybe we in the fixed income first chapter we learned we have tranches, like we had senior and subordinate debt. You can refer to fixed income first video. We have a small glimpse of it. So basically ABS it's a pool of investment vehicles of financial assets. Like it may include anything like mortgage, car loans, credit card offer debt, etc. Now what is actually hedge fund? Hedge fund is organized as limited partnership. It is very important. It is a limited partnership with the investors as the limited partners. So investors are becoming here a limited partners and the fund manager as the general partner. Okay, so who is the GP here? GP is fund manager. Now who is the limited partner here? Investors. Okay, it was a new concept as to learn. Hedge fund utilize various strategies and purchase it usually restricted to investors of substantial wealth and investment knowledge. Hedge fund you often use leverage, so they can use leverage too. Now we can write an extra topic because this is somewhat good, somewhat out of the box. Hedge fund is, we have GPLP concept. Okay, it is limited liability partnership. Now it uses leverage. Okay, hedge fund managers are compensated on the amount of assets as well as on the investment result. So they in like their fees is based on incentive and performance fees. Okay, we will learn the calculations in more in alternative investment subjects, how they are calculated. So professor's note, asset backed securities are described in more detail in fixed income, that only I told. Mutual funds and ETFs are discussed in portfolio management. Hedge funds are discussed in alternative investments. So we just need a glimpse of it. Rest all we will learn subsequent chapters. Now let's move to currencies. Currencies are issued by government. So we have learned about financial system. Okay, what all we have learned here, let's see in a quick glimpse. We have learned that there are three main functions. Okay, and we have learned about classification of assets and market. Now then we learned about securities. We told about we will learning about security, currency, contract and commodity. Now we have look about the security in detail, that there are two type of security, fixed income and equity, and we have gone in depth about fixed income, like we have seen CP, notes, bond, bill, COD, etc. These are just were terminologies. And we went into depth for equity securities. Equity securities, we saw common stock, preferred stock, warrants. Then we saw pooled investment vehicle, like we saw mutual fund, ETF, ETN, hedge fund, and we saw ABS too. Okay, so now we will be moving to currencies. So we now currencies is now an interesting out of the box topic. Mostly everywhere we get to learn about equities only. So currencies we get to learn like less. So let's learn about currencies. So talking about the currency, let's go line by line. Currencies are issued by government central bank. Who issues? Government central bank. Very much 5-year-old line. Some are referred to as reserve currency, which are those held by governments and central banks worldwide. Okay, so there were in our history there were only like 4 to 5 reserve currency. Reserve currency is the currency which is accepted by worldwide most of the countries. Like today it is dollar, yeah, earlier it was euro. So likewise we should be aware of the vehicle current reserve currency. Reserve currency is the most common currency which is accepted worldwide, and countries actually store it today. Even China, after dumping dollars, you have restarted to buying dollars. So it's like I'm linking to present scenario. So these include the dollar and euro. I told it earlier it was euro and now it is dollar. Secondary, the British pound, Japanese yen, Swiss franc. So these all have been one time reserve currency. So it's actually changes, now it's dollar. So in spot market, currencies are traded for immediate delivery. So we learned about type of market. What is spot market? Where we can trade immediately. Now let's speak about contract. So now actually we had what all we had to learn. We had security. We had to learn about security. In currency there is just 4 lines. The 4 lines just talks about who actually issues currency. Government, central bank. Our central bank is RBI. US central bank is Fed. So every country has their own central bank. Then we talk about reserve currency. That is all. Now let's move to contract, then to warranty. So going in this substantial order. So what is actually contract? Contract or agreement between two parties. Everyone knows. Such a baby point that requires some action in the future, such as exchanging an asset for cash. Financial contracts are often based on securities, currencies, commodities, or security indices. They include futures, forward, option swaps, and insurance contract. So there is nothing much. So currency I am cutting down here because nothing is there. Now contract, just I will write that currency we have learned that who issues and what is reserve currency. What's that reserve currency was only the major point. Now what is contract? Contract is just an agreement between two parties. Now we have two bifurcation, I guess. Sorry, there are so many. So we will be learning on first on forward contract, forward, then futures, then swap, then option. Is there anything else? Insurance, CDS. Okay, insurance, then CDS. Okay, so these are just basic glimpse of contract. So what is actually forward contract? In the very simple terms, if you're doing in an exchange, that is futures. If you're not doing an exchange outside in OTC, over the trade counter markets, they are forward. So doing in an exchange, futures. Not doing an exchange, it's forward. Okay, I'm meeting a person. Let's do a contract. Sign a paper. Okay, let's do this contract. It's an OTC deal. You come to the exchange, man. I will only do in the exchange, like Saroda, Binance, everything. You're doing in the exchange means That is a future. So what is written? Agreement to buy or sell in the future at a price specified in the contract to its exception. Agreement to purchase 100 ounces of gold 90 days from now is a forward contract. Forward are not traded on exchange. This is the major point. As stored is an example. Okay, so they are not traded on exchange. Okay, so the forward contract means you are agreeing with a person that you will do, you are you will buy or sell so and so on this rate with so and so agreements and all, with your own restrictive and affirmative statements. Now what is the actually futures? It is standardized and traded on exchange. Okay, that is the major point here, and they are liquid investments. Okay, so in a swap contract, swap means if there are two persons, one is exchanging for anything for the other, that is actually swap. Okay, so in a swap contract, two parties make payments that are equivalent to one asset being traded for another. Okay, like one person is telling that as Nifty goes down, I will give you 100,000 rupees per point. Per single point, this guy will give 1,000 rupees to him. If 1,000 rupees doesn't go in the side, this guy will give to him. So this is actually customized. It's an OTC deal. So they can actually frame their own agreement. So these are actually swap. So in a simple interest rate swap. So here one more type is coming of swap. Floating rate interest, we have learned in the fixed income first chapter. Floating rate interest, we usually refer to MRN, market reference rate. I told that it's a rate which is a variable rate such as SOFR, LIBOR. Okay, so floating rate interest payments are exchanged for fixed rate payment over multiple settlement date. So this guy over here, so what is actually interest rate swap they are telling? This guy is telling, I will give you variable interest rate and you give me fixed interest rate. Now what will happen if fixed rate is 10% that guy is giving and the variable rate is just 3%, this guy is winning, right? This guy is getting extra 7%. 10 minus 3, 7%, this guy will get. Yeah, so if the variable interest rate actually gets more than 10%, that guy will get. So this is actually interest rate swap here. Now another currency swap involves a loan in one currency for the loan of another currency. You give me dollars, I will give you Indian rupee, everything for loan. Okay, for a period of time. Now there is one more thing, equity swap. Equity swap means involves the exchange of the return on an equity index or portfolio for the interest payment on a debt interest instrument. Means I am exchanging an interest gain on an equity index or portfolio for the interest payment of a debt instrument. Like two guys are meeting and that guy is telling me I am holding debt, that guy is telling that I am holding equity. Now equity have interest payment, now equity debt have interest payment. Now equity guy will be earning some earning some returns. Now this guy is telling that I will give you return, you give me interest. So this is actually a swap. Okay, so this was an equity swap. So in this swap here, in this swap we had three types. What all we learned in a glimpse, it's actually for a knowledge purpose. We learned interest rate swap, we learned about a currency swap, one currency for the another as a loan. We learned about equity swap. Okay, now we are talking about options. So forwards are not traded on exchange, futures are traded on exchange. Swap means two parties are coming and they will be transacting with each other according to their condition. If it's an interest rate swap, they are actually one guy will be giving fixed and one guy will be giving a variable interest rate. Talking about the currency swap, one guy will be giving one currency for the one guy will be giving another currency as a loan. So like dollar, I will give you INR, you give me dollar as a loan. Now we're talking about equity. One guy will be giving the equity returns, one guy will be giving debt interest payments. So this is actually a swap. So two agreements, two parties are coming and having an agreement. So now talking about the option contract. So this is somewhat different and not many who don't would have not basics. Gives the owner the right to buy or sell an asset at a specific exercise price at some specified time in the future. A call option gives the option buyer the right to buy an asset, and put option gives the put option buy the right to sell an asset. So it was very simple. So there is we in the share market, there is futures and there is option. If you predict that market will go up, you are using call option, and it is mainly termed in CE. And if you predict that market will go down, you are using PE, put option. Okay, so it gives the right but not the obligation. So it's just a basic definition. So you can actually this paragraph actually talking about the sellers. So it is very simple. Like if these both are buyers, this is both are buyers. Call option buyers, put option buyers. Put option buyers means you are bearish, call option buyer means you are bullish. Now if you are a writer, means if you are a seller, now call option seller, CE seller, and put option seller means if you are selling a call means you are bearish, and if you are selling a put means you are bullish. Means there is much depth to it, but I just told in a very simple way. If you want a logic, if you want one guy is buying, so another guy is selling, there is a buyer for a buyer for every seller, right? So if the one guy is bullish, the other guy must be bearish, right? So this is actually seller. So let's see what is written. So seller's option receives a payment referred to as option premium when they sell the option, but incur the obligation to sell the asset at the specified price if the option price chooses to exercise it. Okay, so this is mainly talking about equity. Now options on currencies, stocks and stock indices, futures, swaps and precious metals are traded on exchange. Okay, customized option contract are also sold by dealers in the OTC market. So options are of two types. It would be either be in OTC or either would be in exchange. So it can be both forward and futures option. So option can be both forwards and futures. Sorry, it can be traded on exchange and it cannot be traded on exchange. Don't mess it up. Futures is just a different instrument. And now insurance contract. What is an insurance contract? Insurance contract pay a cash amount if a future event occurs. Okay, so I'm taking a health insurance, and if something happens to me, the insurance company will pay. So it's a future event. Okay, they are used to hedge against unfavorable and unexpected event. I took a fire insurance, my factory got burned and I lost by fire. Now my loss by fire insurance will give me whatever I have lost, right? So example include life, liability and automobile insurance contract. Insurance contract can sometimes be traded to other parties and often have tax advantage payouts. Okay, very simple, nothing there. Now one important is CDS. Before coming to CDS, let's revisit 2008 Michael Burry short. So in 2008 what happened is, Michael Burry, an investor, believed that he actually runs a fund now, fund named as Sion. Okay, so actually what he found out years ago was housing market had a great bubble. Nothing is inside, but just it's a great bubble. So like he went into an agreement, like I will give you a fixed premium. Okay, now housing market was that time in 2007 and all ago was AAA plus. Now he told that there is double A, there is A, there is triple B, double B, B, right? So he told that as soon as the housing market rating downgrades, you have to pay me back the amount, the amount as they prescribed. But if the housing market doesn't actually downgrades, I will give you amount. So actually this guy just housing market actually collapsed in 2008, and recession broke out, and he just cashed he was very famous in our books of history as a trader, and a movie named as The Big Short was on him, this short story only. So this is actually credit default swap. I just told you everything in this short story only, so to make it more interesting. So are a form of insurance that makes a payment if an insurer defaults on its bond. They can be used by bond investors to hedge default risk. They can also be used by parties that will experience loss if an issuer experience financial distress, and by others who are speculating the issue that will experience more or less financial trouble than is currently expected. So coming to the LOS here, we just learned about contracts. So contracts are many. It can be forwards, which is not on exchange, and agreeing to a future specified price, future specified date. You will transact this much amount or this much quantity at a future date. And futures means you are basically doing everything as a standardized in an exchange. And we talk about swap, we talk about, it's basically two parties coming together, and basically outside the exchange they are forming an agreement that they talk about their favor. Like an interest rate swap, one is just putting an agreement with the other that I will give you fixed interest rate, you give me variable interest rate. And we talk about currency swap, one just loans to the other currency, and like I'm giving you INR, you give me dollar. Now rest we have equity swap. Equity swap means we told about that I will give you interest rate returns, you give me debt interest, what all the interest you are paying as a debt. So this was only a swap. Now options, we learned that he have the right but not the obligation. And we told about call option, put option. Call option means you are bullish, put option means you are bearish. If you are writing it, it is opposite. If you are writing call option, it means you are bearish. And if you are writing put option means you are bullish. There are much depth to it, but not I'm going to it. Actually writers actually are smart, because they are taking an unlimited risk here and buyers actually have a limited risk. And we talk about insurance contract, it's basically an hedging. If any unfavorable event happens, I will be recouped. Now last I talked about CDS. CDS means I talk about 2008 Michael Burry short. So basically I am entering into a contract with the other, like when the credit actually defaults, then I will get the payment which is due, or otherwise I will have to pay the premiums, as you just pay the premiums in health insurance, life insurance, and that according to the depends also according to the agreement. Now let's go above what all we have to cover, how much we have covered. So LOS3 consisted of security, we have covered, currency we have covered, now we have to talk about contracts, now we have covered. Now we are talking about commodity, so it was a very big LOS here. Now we are talking about commodities in detail. I don't think commodities are very much. So commodities are traded in spot, forward and futures market. So spot market is different. Spot market means immediate delivery. Forward means you are not trading on exchange. Futures means you are trading on an exchange. It is more standardized, and if you go into it, has many advantage and disadvantage. They include precious metals so commodities include precious metal, industrial metal, agricultural products, energy product, credit for carbon, everything. Futures and forward allow both hedgers and speculators to participate in commodity market without having to deliver or store the physical commodities. Now moving to another, real assets. What are actually real asset? Real asset means that we talked about there are two types of asset, financial asset and real assets, right? Now we are talking about real asset. So examples of real assets are real estate, equipment, machinery, which all can be touched. We told that touched. financial assets, stock, bond, derivative, actually we cannot touch. But in the real estate, you can touch. Real estate, equipment, machinery, you can touch. Although they have been traditionally held by firms for their use in production, real estate are increasingly held by institutional investors, both directly and indirectly. Buying real estate directly often provide income tax advantage and diversification benefits. However, they often entail substantial management cost. Furthermore, because of their heterogeneity, they usually require the investor to do substantial due diligence before investing, because we actually talked about that it's not easier to value it. They are illiquid. Okay, they are illiquid, and it is having substantial management cost, and because specialization may result in a limited pool of investors for a particular real estate. So real estates are not traded with so many, like as compared to futures. Now let's talk about, rather than buying real estate directly, an investor may choose to buy them indirectly through an investment such as real estate investment trust, REIT. So we can participate in real estate by directly and indirectly too. You can go purchase a land, or indirectly, if you want to go, you can just go to you can purchase a unit of trust of REIT or master limited partnership. So when you hear from now that anywhere like MLP, if you are hearing, it's like indirectly you are participating in real estate. So it's a good commendable knowledge over here. New learning we have got: the investors own an interest in this vehicle and holds the asset directly. Indirect ownership interests are typically more liquid than ownership of the asset themselves. Another indirect ownership method is to buy the stock of firms that have large ownership of real assets. Simple as that, nothing much complicated. Real estate, they have just told it's like what you can touch, and these are real estate, equipment, machinery. The second paragraph talks about its characteristics. It's illiquid, it has substantial management fees. Okay, now third paragraph talks about real estate types. How can you participate indirectly? You can participate to REIT and master limited partnership. So commodities, nothing was there. And in real estate, real asset, we just talk about what are physical, what can be touched. Okay, now, and we just talk about the characteristics, and we talked about REIT and MLP. Okay, now let's talk about describe types of financial intermediary and services that they provide. So who all are the financial intermediaries here? Okay, so financial intermediaries stand between the buyers and sellers, facilitating the exchange of an asset, capital and risk. Their services allow for greater efficiency and are vital to a well-functioning economy. Financial intermediaries include brokers and exchange, dealers, securitizers, depository institutions, insurance company, arbitrators and clearinghouse. Everyone is financial intermediary. Financial intermediary means if you want to buy a stock, okay, you want to buy a stock, you are the buyer and there is a seller. Like company, like Reliance company itself is the seller. Now whomsoever is in between is the financial intermediary here. They can be brokers, exchange, dealers, securitizers, depository, etc., 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 as we discussed. Okay, so they stand between them. Okay, now let's write it down. Who are financial intermediaries? Intermediaries. So they are just middle person. Okay, so they are just a middle person facilitating the transaction here. Now let's talk about we actually told here some of the financial intermediary here, right? So we are first talking about brokers here. So brokers, dealers and exchange we are covering up here. Okay, so who are brokers? Brokers help their clients buy and sell security by finding counterparty to trades in a cost efficient manner. Okay, so if I want to buy a security, my broker will fetch another counterparty for me. They may work for large brokerage firm, for bank or at exchanges. Okay, like there is Aroda, there is Grow, there is Motilal Oswal, there is Kotak. Every firm, what do they do? They just find a buyer for a seller and a seller for a buyer at a cost efficient manner for the both parties. Okay, these are basically financial intermediaries. Okay, so broker is the one who just finds the other counterparty at a cost efficient manner. Now, who are block brokers? Okay, this is something new to us, right? Now let's read it. Help with the placement of large fund. So if I want to place a large fund like 1,000 crores, I cannot go to Saroda and place a limit like place a market order there. Okay, so it would affect liquidity, it would affect cash price, especially it would affect the stock price, especially if it is a penny stock and all. So block brokers help the placement of large fund. Typically large trades are difficult to place without moving the market. Yeah, if you are moving a penny share, it would be actually volume would be around less than 10 lakhs. Now you are coming with 5,000 crores. What will happen? Right, so there will be a drastic price movement also and very much illiquidity also, and actually like it's very speculative too. Typically large trades are difficult to place without moving the market, right? For example, large sell order might cause a security price to decrease before the order can be fully executed. Block breakers help conceal their client's intentions so that the market does not move against them. Right? So if I am placing a large buy order and the now the market knows there is a buy order sitting there, I have to punish him. So you are actually got victimized here. So so to handle the situation very smoothly, there are block brokers. Now there are investment banks. Investment banks helps in mergers and acquisition, helps in issuing, like I'm a private company, I want to raise an IPO, I should receive at least 75% of the application. If 70 only if I receive 50%, rest 25% remaining, actually investment banks are the one who just steps up and helps to achieve by underwriting to 75%. Okay, so let's read it out. Investment banks help corporations sell common stock, preferred stock and debt security to investors. They also provide advice to firm, notably about merger, acquisition and raising capital. Okay, so this they just told what the investment bank do. Okay, so rest we are talking about exchanges. Provide a venue where traders can meet. Okay, so if I am a buyer and there is anyone anywhere in India, one seller is sitting for a Reliance share, so I just placed an order. Now the exchange actually finds it actually forms a marketplace where buyer and seller, my counterparty, can meet me easily. Exchange sometimes act as a broker by providing electronic order matching. Exchange regulate their members and require firm that list on the exchange to provide timely financial disclosure and to promote shareholder democratization. Exchange acquire their regulatory power through member agreement or through governments. So exchange was very simple. Just remember Saroda, Grow, Motilal Oswal, Kotak, etc. Now we are talking about ATS. Now exchange we have seen. Okay, we are talking about a financial intermediary. These are all the financial intermediary. So we are now talking about ATS, alternative trading system, which serves the same trading function as exchange. So basically ATS is also an exchange but have no regulatory function. So it's basically risky, right? So Saroda, everyone is have regulatory function. They abide by the law, by SEBI, by RBI, everyone. But ATS is not abided by regulatory function and are also known as electronic communication network. So ATS is also known as electronic communication network or multilateral trading facility, MTF. Okay. ATS that do not reveal current client orders are known as dark pool. So here one more thing is coming, as they are not abided by multilateral trading, thus they are not abided by the law, they can actually have dark pool too. Now it doesn't reveal the current client orders to anyone. So basically, if an exchange is regulated, it is an exchange. A marketplace which is regulated, it is an exchange. A marketplace which is not regulated, it is an ATS, alternative trading system. Now let's talk about dealers. Okay, one of the element of the financial intermediary, one of the people here. So who are the dealers? We want up to now brokers, dealers, everyone is same, right? Now let's go deep into it. Dealers facilitate trading by buying for or selling from their own inventory. Okay, like market makers, dealers provide liquidity in the market and profit primarily from the spread between the price at which they will buy and the price at which they will sell the security or the other asset. Okay, so these are basically, when you talk about dealers, you just think about market makers. Now I will tell you, like, it's a another concept. Okay, now what does the market makers actually do? I'm sorry for the disturbance, elections are everywhere. So what the market makers actually do is, there is an order book. Okay, order book is there: buy, sell, 100, 105, 106, 106 is there, 200 is there, 108 is there, 550 is there. Okay, so these are the prices at which the now it have been quoted. Okay, now what is happening is, now actually the current market price is 106 and 200. Now if anyone want to place in nearby quantity like 105, let's say it's like 82. Okay, now if I want to place an order of 95, only at the orders are at 82. No, so there is very much illiquidity, right? So what does the market makers do? Market makers come around the market price. And what do? If anyone is selling at 105, they will take out their stock and they will sell at 105 only. Okay, so what is the profit here? Now the price actually fluctuates. The price may go down like 280, 290. So they buy a lot and lot and lot. So when they sell above to make the market, so they are actually gaining the profit over there. So actually they are gaining the spread. Like if the buyer is like 95.2 and seller is like selling for 95.8, so there is a 0.6 spread here. The 0.6 spread is actually the market makers profit here. So they do in bulk. So this is why the price actually cannot vary. So if they have to market make, the prices should be liquid. The market should be that their market should be liquid. Their responsibility is to make that market liquid, and they should deal in heavy quantities, right? So that is only what the dealer, what is all about. I just told you with a real life example what is happening. So every crypto coins have an market makers. They make the market and do like that, and many of the stocks everywhere they are doing it. It's like ethical, and if there is no market makers, that market is actually not liquid too. Now let's talk about broker dealers. Okay, so when I talk about broker dealer here, what is actually broker dealer? A special term. So what is broker? Broker means the one who is finding a counterparty to you. Dealer means the one who actually have a lot of inventory and who just market makes. So from now you should bifurcate the difference. Now some dealers also act as brokers. So when does brokers act as dealers? Broker dealers have an inherent conflict of interest. As brokers, they should seek the best prices for their clients, but as dealer, their goal is to profit through spreads, right? So as a result, traders typically place limit on how their orders are filled when they transact with broker dealers. So broker is the one who wants best price for the clients. Dealers are the one who want profit. So these guys are client centric, these guys are self centric. Okay, so dealers that trade with central bank, when banks buy or sell government securities in order to affect the money supply, are referred to as primary dealers. Once more, dealers that trade with central bank. So there will be huge big dealers who are capable to trade with central bank in big amount when they buy or sell government security in order to affect the money supply, are known as primary dealers. Okay, so dealers also have primary dealers and broker dealer. Broker dealer actually fulfills both. It actually gives the best fit price and it actually makes profit. If a dealer is not a broker dealer, he actually looks for profit in the market by order books. Now he will not try his best to make to give the customer the best possible price a client can take. Okay, so this was the one whole about the financial intermediary. Here we talked about broker, block breakers, exchange, ATS, dealers, primary dealers, and broker dealer. Okay, now let's come to securitizers. Okay, securitizers actually pool large amount of funds. Okay, we actually learned in that pool investment vehicle, right? So they pool large amount of securities or other assets and then sell interest in the pool to another interest. Okay, their returns from the pool net of the securitizers fees and pass through the investors. Okay, so like I have MBS, ABS, I'm taking lot of credit card debt and I am gaining some returns, and I am, after that gross returns, I will just deduct net whatever the fees of mine, and I will pass on to directly to investors. By securitizing that asset, the securitizers create a diversified pool of assets with more predictable cash flow than the individual assets in the pool. Like if you are to pay home loan, every month there is an EMI, right? So this is actually the every home loan, if that is clubbed, that is an MBS, mortgage backed securities. So it's very predictable that most of the customers have the due date on 10th of every month. So it's predictable cash flow, so we can plan accordingly. This creates liquidity in the assets because the ownership interests are more easily valued and traded. They are also economies of scale in the management cost of large pools of asset and potentially benefit from the manager's selection of assets. Okay, it was very vague and very basic too. Okay, now let's move to second paragraph. Assets that are often securitized include mortgage, car loan, credit card receivable, bank loans, equipment leases, everything. The primary benefit of securitization is to decrease the funding cost for the assets in the pool. Okay, a firm may set up SPV or SPE to buy firm assets which remove them from firm's balance sheet and may increase their value by removing the risk that financial trouble at the firm will give and other investors a claim to the assets cash flow. Now there is an important concept they are speaking. Let me tell you, there is like Yes Bank. Okay, in the balance sheet, it is having MBS, mortgage backed securities. Okay, it is having let's say it is having home loans. They are having 10 cr. I'm speaking very less amount just for basic calculation. Now what Yes Bank actually did is it's actually given out aggressively. Out of this 10 cr, 9 cr they are expecting now to default. Now the financials will go down. Their balance sheet have this thing, man. Though how will the stock price actually will go up? Analysts will be seeing that only. Now you can actually, that home loans have a fixed cash flow. Everyone will be paying like monthly 10 percentage. Now what you can do is you can shift the Yes Bank will make one more company, SPV or special entity. Now it will actually, what it will do, SPV will purchase, SP will give cash 10 cr to them, and they will actually Yes Bank will sell its home loans, that is mortgage-backed securities, to to its SPV. Now there is, the balance sheet is clean, nothing is there, 10 CR cash is there, they already have got, they were supposed to get over the period of time, but now only they have got everything. So it's very much okay. Now SPV, if it's default, it cannot affect the parent company, it is a different entity. Okay, so this is actually securitization topic we are learning here. Now the MBA, now everyone is subscribing. A is subscribing, B is subscribing, C is subscribing. A is subscribing for 5 CR, B is subscribing for 3 CR, and C is subscribing for 2 CR. Okay, now what happens is MBS 10 CR, actually one investment pool is there, so A is subscribing for 5, B is subscribing for 3, C is subscribing for 2, and every year they are promised to get this much percentage as returns, fixed cash flows. Okay, so this is actually the concept of securitization given here, nothing more. The cash flow from securitized asset can be securitized by segregated risk. Okay, and the different risk categories are called tranches. We have learned that tranches means I want, means my firm is liquidated, now whom to give. Okay, if this SPV is liquidated, whom to give? There will be equity shareholders, there will be preference shareholder. In preference shareholder there will be senior debt holders, there will be junior debt holder, which are also known as subordinate debt holders. So this is actually tranches. The senior tranche provides certain cash flow, and with, while the junior tranches have greater risk. So here they are talking about the MBS is also having senior and junior. Okay, now depository institution. Okay, now what does the depository institution talk about? Depository institution talks about let's see how much pages are remaining. It's 245, right? Page number. We are coming on LOSE. I think there is up to LOSL, right? F, and there is one more, I guess. There is J. Okay, so we have to cover many more concepts. So we are having like D, E, F, G, H, I, J, K, L, right? So there are much concepts left. So we are in 237, right? Okay, we actually 247. Okay. I think I should wind up the class here, or it will go very lengthy for you. So this was the second video, and in third video I will try to cover the rest LOS in the readings. So it is comparatively a long reading, I believe. So we will, in the next video we will be continuing from depository institutions. Okay, so I hope you liked this video, you like the concept, and I was able to cover line by line everything, and everything was pretty clear to you with the real life examples and notes. So let's meet in the next video and finish the full chapter over there. Thank you.